That puts actual mom and pops probably down to 50% or less. If you look at the mom and pops that are institutional grade, that's probably less than 10% at this point. You go into major cities, everything else, it is going to be hard for you to even find a mom and pop person at all. Welcome everybody to Self-Storage Income, and today I have my good friends. They've been on the podcast multiple times before. They've also been at our event and spoke. We got Andrew and John here. Guys, you already know you're like my favorite guest. We can talk forever. I love our conversations. We literally, before we even got on, we were already in one. And it was like immediately like, oh, okay, no, we got, hold on. We gotta wait. Like this is good stuff. But for all the people that haven't heard you guys on the pod before, that weren't at the events, didn't see or hear you speak, you guys want to do a quick introduction to you guys, how you got started, and then also where you're at today, because your story is amazing.
Sure. I'll kick it off. I'm Andrew. John to my right, but might not be able to see that. But long and short of it is John and I started an e-commerce business that took off beyond our wildest beliefs. As we had success there, we wanted something to parlay some of that surplus capital into. We both had a love and affinity for real estate. John had some experience building up a multifamily portfolio in Wisconsin. I was dabbling as well with multifamily condos in Minneapolis. And we very quickly realized that multifamily was not the asset class we wanted to grow with or into. We didn't know where we wanted to go. And in 2016, on Craigslist of all places, we found an opportunity to assume some debt to take over a mismanaged self-storage facility in Black River Falls, Wisconsin. It was about 3 years old at the time. It wasn't dilapidated by any means, but the gentleman had just run it into the ground. So as John and I were building our e-commerce business, we jumped in headfirst into the self-storage realm as well. We touched every single moving piece of the business. From a young age, when other kids were learning T-ball, I was learning debits and credits. My dad was a CPA, so I handled all the bookkeeping. I answered the phones exclusively for 2 to 3 years. And as quickly as we found an operational inefficiency, I'm ringing the bell to John, who had a background with Deloitte doing technology consulting, saying, hey, we need to reduce this moving part. We need to remove this inefficiency. We need to streamline this operation. Let's make this a tech-first approach. And so that's kind of what we did. And furthermore, we saw the cap rate compression and we saw the rate compression in these large markets. We opined that if you're an institutional buyer of self-storage or REIT, a publicly traded company, et cetera, you can only show so much growth in these large metropolitan areas. And eventually you're going to need to go out to these B sub-tertiary markets. So essentially we took that tech-first approach to the B and tertiary markets in 2016. At the time, not too many others were chasing those assets. And that's kind of what we did for the first few years. As I'm sure most of your viewers know, a lot of the value add or the drive for value creation on these assets is additional scale by way of building. Oftentimes you find these mom and pop operators who are risk or debt adverse. And so for whatever reason, they haven't fully maximized the value by building. We were building on a handful of locations, and we decided, being that it was such an integral component of our strategy, our growth strategy, we needed to bring construction in-house and start our own construction company. Building in 24 different states and a handful of different municipalities left a lot to be desired. So we started our own construction company, and we just continuously kept growing. Fast forward to today, we've got a management company, and then we've got about 220 to 225 assets, 8 million square feet, 24 states. A lot of our growth has been by way of acquisition, but a lot of our growth is also by way of development. Our construction team has, for the most part, done builds for us exclusively, but has also started entering the market for doing third-party builds for other operators. So to date, they've built 1.5 million-ish square feet. We've got another 1 million in our pipeline. And we're just continuously growing and having fun while we do it.
It's amazing, your guys' journey. It's been so cool to see, when I remember when you guys were at whatever it was, 2 million square feet. And I think that was when we first got introduced, and you guys got there like that, like really fast. And that was impressive to say the least. And, I think talking with a lot of people, a lot of people even wondered if you could keep your growth up. And I thought, you in your strategy was actually primed for much more growth than other people's strategy, including mine, by the way. Like I believe that you guys had a better runway than I did. And the reason being was some of the things we were talking about before and what we saw coming in the industry, and something you guys have capitalized very well on, which we'll get into that. I want to talk about your runway, how you got your growth, things like that. But John, what else do you have to add to that?
He did such a great job. I don't know.
He doesn't tell me that very often, so I'll take it.
Usually I'm the one talking too much, but no, I mean, it's been a crazy ride. And I mean, where we started to where we are today, I think we've talked about this in the past with you too, but what your problems are when you have 1, 2, 3, 4, 5 stores compared to when you're, overseeing 200 and raising equity in a different capacity and everything else. You start to kind of get a different sense and a different pulse of the overall market and what's going on and the moving pieces. And I think, as Andrew kind of reiterated, we talked like, how do we differentiate ourselves from any other, private equity backed aggregator, from you guys, from the REITs, pick your person in their group in the top 100 operators and what sets us apart. And, I don't even know if we could have answered that early on, but it's starting to become a little bit more clear. You see a lot of posts and everything on LinkedIn about, why people want at least 40,000 square feet or why they need an MSA of at least this size. And, I agree with all that and it meets their criteria. I think you even talked about in one of your prior podcasts, just really finding your buy box and like what fits your model and why you should stick to that and what you should do. And I think we've done a pretty good job of that. And it's really a one-to-many strategy. We've raised equity in different fashions, but it's always been from friends and family. We don't really have any institutional investors to date. Every lender we've pretty much worked with has been community-esque lenders from, $250 million in assets to like $10 billion in assets, kind of the sweet spot where they're, still small enough where they really have that relationship, backed lending type aspect. But, big, once you get into, kind of say, $3 to $10 billion range, they're big enough where you don't just do 2 deals and kind of, lose touch right away, and you can kind of build a template to repeat it. And then really, as we think about the facilities we own, 220-ish in 24 different states. You can imagine the diversity when it comes to your tenant base, what drives demand, populations, the quality of the facilities alone, and really how you need to operate them. When we started doing the tertiary market strategy, it was, hey, Andrew and I can do this all ourselves, and we'll answer the phone and we'll pay a guy that lives across the street and McDonald's gift cards to go walk the facility once a week for us. And, fast forward, over the course of the years, we built up more and really brought in a lot of really sharp, smarter than us individuals to help run our operations and scale them, many of whom had backgrounds with the public REITs or top 4 consulting firms, et cetera. They really brought in a lot of process and structure, and we kind of started moving towards commonalities. Like, hey, we need to do the exact same thing, have the exact same format, the exact same structure across all these markets. And that worked for a bit. And then we also realized, hey, we're still one to many. What works in Chattanooga, Tennessee might not work in Mount Pleasant, Texas, might not work in Maine. So we've also had to kind of, pull back a little bit, with what's going on in the capital markets, slowdowns in acquisitions, slowdowns in all transactions, building, we really took the opportunity over the last 6 months, still underwriting 10, 20 deals a week, but really focus our efforts internally and say, what can we do to control our controllables? And, just simply looking at the slow creep of expenses, might sound crazy, but something as silly as like a cable and internet bill going from $50 a month to $100 a month, when you multiply that across 200 facilities, and then you're taking that in line with your lawn care, your snow care, your various on-site staff, you're seeing insurance increases, property tax increases across the board. You're kind of getting hit by all angles, and it's not like one massive expense that's doing it. But if you don't have your eyes on it, you're not watching utilities, everything. When you are in these more tertiary markets, you don't have the luxury of having a 100,000 square foot facility bringing in $1.50 a foot a month to absorb some of that stuff. You really have to watch every single line item. So we went through every single budget, reforecasted, and found, I think almost $3 to $4 million in projected savings just on the expense side on our various holdings and across the portfolio for this year. And in Q1, we've already seen that come to fruition. So, you mentioned the growth trajectory we had, certainly we always like to think of business as this kind of pendulum where you're swinging on one side, massive, crazy growth, no attention to detail, no attention to your operations. And then on the other end, this analysis paralysis where you just look at everything and everything's got to be perfect before you can move forward. And, there's not really a sweet spot. Like, I think really, if you're doing it right, you're kind of swinging this pendulum a little bit back and forth, maybe going 30 to 50% each direction and moving as you need to. And so, what we see the slowdown in growth is like, oh shoot, we'd love to keep growing at the rate we were. It was really kind of good for us to take a step back, look inside, get back to the basics, blocking and tackling, and just execute on kind of the initial mission we had and ensure that, the organization as it's grown is aligned. And then so that's proven really beneficial. And I think, we're well poised, coming through this. Some of our early advisors were really big on saying get long-term debt. So, all of our debt's 5, 7, 10-year fixed rate stuff. So we don't even have any expiries for another 2-3 years. And those are long-term holds that are really low loan to value. And the one-to-many helps a lot too. It's not single asset risk of, $20, $30 million loans. It's a lot of $3 to $5 million loans on multiple assets across the country. So certainly our first cycle, we've been doing this stuff in storage for 7-8 years now. And, the broader, multifamily stuff you mentioned was just pretty small stuff. So haven't really seen the macro impact, but it's interesting. It's a little scary, but I think we knew it was coming. We didn't know what it was going to look like, and I think we've got the pieces in place to weather the storm and hopefully come out stronger than ever. So
it's a common theme, and I was actually making our investor videos yesterday. I do investor videos just to get people updating stuff, especially like on our funds, and look at the performance and track and looking at what's transpired from 22 to 23. So the fall of 22 was bad. Winter of 23 was bad, right? And then the busy season for most our markets never came. So like a lot of it, I'm like, you can see in the numbers a lost year. Literally a lost year. It just nothing happened, right? And that can be hard, especially for investors and other people that are like, no, this industry just goes up all the time. It never doesn't not perform. It's so easy. It's just cash cows, cash machines. And you got to remind people like, no, this is just like any other industry. Every year things change. Sometimes you have down years, sometimes you have up years. And I actually have to show performance of our assets through like 2008. When you go, if you looked from 2000 and let's say 6 to 2016, we had 2 years that were down years that looked like you were so far back. But then we had 2 years that were up years that were so big, we blew out any projection that we even had, even with those 2 down years. So it's like, that's not how it works. We've just been in a period where the vast majority of, so if you look at it now, the most people that are in the workforce today in the United States, by far, in sheer numbers, have never gone through a recession. And so when you look at that, the how they perceive investments too is kind of wild, where it's like, I don't understand why this just doesn't send me checks and why it doesn't go straight up. And it's like, there's lots of things we have to do, right? And you guys take the approach like I take. It's like, no, we understand there's changes in the economy and that's okay. So we set up and we structure to be okay with it and we go through it and we keep success. Success happens over long term, right? But what it's caused is for our industry, me, my firm, your guys' firm, everybody's firm, to reinspect and go back to basics and operations, everything else. Now, I had a conversation and they're like, well, why weren't you doing that before? And I had to explain, when you're 100% occupied and rates are going up 20% a year, you don't know what's wrong. You can't even see. It doesn't even matter. It's actually a waste of your time to even try. So it's not that we got even away from fundamentals or anything. You couldn't see. There was nothing to know. Nothing was even going wrong, right? And so it's not until, like Warren Buffett talks about that tide goes out, who's swimming naked. And the question is, the tide goes out to everybody. That's the key. So everybody's standing there. Oh, great. We're all out of the water now, right? But some people did, like, you're talking about, we have good operations, we have fundamentals, we have long-term debt. So we're still moving forward. We're back to basics, right? Some people have their swimsuits on. So when the ocean comes back, we're all swimming again, right? And it's fun. But then other people, they aren't. They're left trapped. And I think when you look at growth, there's a few different types of growth. You have that internal and external, right? You guys are predicated on that internal, meaning you're finding underperforming property to turn around. That's why we've always gotten along, right? Same type of thing. And I think that it's really interesting looking at your guys' overall growth, how you've been able to sustain and what that means moving forward. And this comes down to my perception of why I think not only you guys' growth has been good, but why it'll continue and why you guys are doing it. We're going to talk again and you guys will be double in 4 or 5 years, right? The size that you're at. And this is just going to go on and we'll just do this, guys, every few years. You'll come and be double. We talk every year. You'll be on the podcast every year, but every few years you'll be double again, right? That's how it's going to work. So this is a lot of fun.
When you guys are looking at property management software for your storage facilities, there's a ton of options out there, but no other option compares to Tenant Inc. Tenant Inc. is going to be your one-stop shop solution that has an amazing amount of tools that you can deploy at your fingertips to maximize the value of your facility, to operate it more efficiently, more effectively. They have an open API where you can back in almost anything you want. You own your data, and it's just an incredible solution. I can't say enough good things about these guys. Link is in the show notes. Be sure to check out Tenant Inc.
Why don't you kind of dive in before we get to more of that growth stuff, everything? Let's talk about the changes that you guys have seen from 22 to now, what it means for the industry, your strategy. You talked about the expenses, which, by the way, holy cow, guys, property taxes. We were murdered on property taxes.
And unfortunately, I mean, we've got a firm we use that, goes and disputes them, but I mean, you're banging your head against a wall. I mean, you really got to show that it's struggling. I mean, it's hard to fight a municipality when this is your purchase price, so, and we found, there's non-disclosure states, there's disclosure states, but for the diligent counties, it doesn't seem to matter too much. And the counties that aren't as diligent, they just kind of are, and it takes longer. So yeah, it's been an interesting one. Insurance, I mean, we're just, there's only so many markets for insuring this stuff, especially once you start getting into coastal markets. And
in the Midwest, you guys have a good presence, right, in the Midwest, and so do we. So when we were shocked in everywhere from like Oklahoma to Kansas, everything else, the insurance came back. We had one facility that said that we had 100%, basically, our rates went up, and they're like, yeah, you have 100% certainty that a tornado will hit. And I'm like, could you send me the date so I can tell our manager not to be there then? Like, wild. The Midwest and the South are really...
Yeah, the kind of the plains areas where the tornadoes hit. I mean, and what we found is it's really state-based, whether or not you're making claims, your asset class is what it is. You're punished just for all the losses because these insurance companies have to be profitable, and it just kind of is the nature of the industry. So, when talking to our guys, I mean, it feels like we're kind of at a rounding off the top, but knock on wood, don't want to speak too soon because another tornado season or hurricane season, and you're right back where you were. But yeah, you just got to be diligent on it. You can't just accept the increases. You got to shop multiple markets, look at combining policies, name storm policies. Really fight these carriers on price per foot. I mean, if they're sometimes they're just like, yeah, replacement costs $80 a foot, and we're like, yeah, if our drive-up facility gets knocked down, there's a good chance, if the pads and step were 30 to 40 a foot to actually replace it. So why would we pay double the rate? So there's just a lot of little things, and it just comes back down to the, something you maybe overlooked and just kind of took for granted when you're growing and revenue's cranking that you got to kind of come back and look at. But, what are we seeing in the industry from 2020, 21, 22 to present? We grew up in it, right? So, when we started 16 to 19, it was just kind of, we could call any mom and pop operator, they'd take our call, could drag it out, buy it. I mean, it was easy. I mean, we were buying stuff, $30, $40 a foot in these rural markets, and anything we bought, to your point, just went up, and you didn't have to think too much, and the competition wasn't that stiff. And then COVID hit, and we had the benefit of, now everybody's really pushing, more and more remote management, or at least augmented, or hybrid type management where possible. And we were just doing that because we didn't know any better. So we just were able to keep the pedal to the metal, full throttle.
And two, you come in. Like a lot of people, it's funny. A lot of people are like, yeah, we're doing this thing called remote management, automated management. We started out everything else like that. And I'm like, yeah, everybody had to do that. So when we got started, the facility couldn't have a manager. I'm buying a 20,000 square foot facility. If I had a manager, I'd have to pay the manager out of my own pocket because there wasn't enough revenue. And so I think that's something that when you guys looked and we were talking about, because of your strategy, you were like, this is the only way we can do it, right? You're forced. But other people hadn't figured that out and come down quite into your market in a way that you guys had. And so when COVID hit, you guys were already going, we're utilizing it. Because like I went the other approach, right? I actually got out of that market and I went up in 2009, right? And so I got out of the remote management, air quotations, because the facilities were 150,000 square feet and right. And so I actually got out of it. And by 2016, I was completely out of remote. You guys started back in that right when you had the technology and you had a repeatable model, but it was like streamlined. And then that's when, you know, by COVID, everybody started to adapt, but you guys already had that foundation really, really well laid out.
And we were young and dumb and rose-colored glasses, right? You know, we hadn't seen it. So COVID hits and we're like, yeah, okay, well, storage is here. We just didn't even skip a beat. And there was a lot of fear, and people that had lived through 2008 were like, I got to sell before this gets worse. And we're just like, buy. So there's a 6 to 8 month window where we were getting some really good deals. And, you know, then as we saw the printing of money, the cheap idle money, I mean, you pick your poison, the free debt. I mean, everyone suddenly just said, okay, we got to run, and cat's out of the bag on storage. And, you know, you'd see these deals hit the markets in 21, 22, even into early 23, and it would hit, and it could be a population 10,000, 6 cap, and if it was a decent quality facility, they'd have 3 bids the next day. And it wasn't even, I mean,
lower than a 6
even lower than 6 caps. And so that was the competitive landscape. So you really had to, you know, grind it out in those years to find deals that can make sense. Granted, you could get cheaper debt, but everyone's just underwriting, yeah, okay, it's a 5 cap today, we'll turn it into an 8 to 10 cap in 2 years just by doing ECRIs. And, you know, I think in some of our earlier podcasts, we were just talking about this. Look at these ECRIs. It's so cool. It's so easy. And now it's like the bane of everybody's existence because the REITs just do it so much more aggressively, and you're just kind of forced into it. And we've got some strategies we're doing that I think will play well, or at least work, because especially in these tertiary markets, you can't do it as much because you're just dealing with a smaller population, and you get a reputation of doing it, and you alienate yourselves overnight. And you know, it's not a population 250,000 where there's just a perpetual churn of new clientele coming and going. And that's kind of why they get away with it in the big markets. But, you know, yeah, I mean, and then, you know, 23 into now, I mean, we've sold a couple properties in the last 6 months, primarily just due to, you know, operators wanting to be in those regions. But the ability of us to package up kind of some of the sales we pulled off in 22, 23, early 23, it just doesn't exist, primarily just because of cost of capital. I mean, you look at what the REITs have to issue their bonds at. I mean, if their cost of capital is in the mid 6s, how do they pencil anything, especially in a tertiary market, below a 7 cap? And they're not underwriting the lifts as much. They're just looking for scale. But, you know, for us, it's really, you know, I mean, our cost of capital now is, you know, 7.5 on the debt side. Our equity's still, you know, pretty much the same, doing up a, you know, 20 to 30% IRR targets and whatnot. But it's harder to get there with elevated interest rates and fewer deals. So, you know, we're looking at, you know, more and more deals and really buying a lot of stuff up, you know, below replacement cost where we can. And
I mean, our acquisition strategy has changed entirely. You know, John kind of spoke about it, you know, as he started, you know, after your question. But again, 2016, 2017, no sense of urgency. This week, next month, come check out the facility. You know, we'll go to the local diner, we'll break bread. And, you know, my tax advisor at H&R Block told me I need $500,000 to live, and my capital gains are this, and this is how I want to price it. No one knew what cap rates were. A few years later, everyone was more educated on their storage facility than ever before. And brokers all told them, you know, you can get these high expectations. And the reality of it was they could, you know, to John's point with what was going on in the macro environment. Fast forward to today, we're still looking at as many deals, but it's kind of this weird time where you've got now more educated buyers, in my opinion, but not educated enough where their expectations have moved with the market. And, you know, you've got the brokers out there, some of which have, you know, done better and planned better than others, who might still be telling them unrealistic expectations just to get a listing, just then to bring it to market, then to tell them, well, hey, actually it's here. And, you know, rightfully so, the seller isn't ready to part ways with it because they have this expectation of a BOV they got from a year, 2 years, 3 years ago. So it's interesting because we still, put a lot of emphasis on trying to, work our relationships and have rapport with, true mom and pop sellers. But those deals are fewer and far between. I honestly believe that most of our acquisitions have come by way of sticking to our guns, being patient and resilient. And honestly, I think 50% of our acquisitions in the last 6 months have been deals that have fallen out of contract, and the sellers just have fatigue. And they're like, you know what? I'm now less concerned about the highest dollar offer. I want the group who can get this through the finish line. I want the group who's not, worried about a financing contingency, an appraisal contingency, etc. I want a group you've worked with on 10 transactions and you can look me at the white of my eye and say they'll be there at the closing table. So truly a majority of our deals right now are deals that for whatever reason fell out of contract, and we've just, we've told the broker or we've told the seller, hey, here's our offer. This is why we're confident in it. We wish you all the best, but if for whatever reason it doesn't work in 1 month, 2 months, 3 months, 6 months, let us know. And honestly, a lot of times when it comes back, interest rates have risen and we can't, keep to our original offer. We have to re-underwrite, but we still will get the deal. So it's been a very unique landscape. I think the other, value add of our organization is, we can do volume. We have the backbone of a large organization, but we're nimble. And if you're a larger group out there, kind of to your earlier point, who has $1 billion or $2.5 billion fund that they've raised, it's probably hard for them to go deploy that fund $2 million at a time. But we've kind of found that sweet spot of $2 to $3 million deals that are transacting in this environment. True mom and pop sellers who are less capital markets dependent. They've had it for quite a while in their family. They've got low basis and they're just really looking to retire, and they're market sellers. So we believe that's kind of where we're finding our stride right now. And again, our approach is, we'll buy 10, 20, 30 of those a month in good months when we can. And our operations team has the backbone to onboard 10, 20, 30 of these a month. And when the time is right, we can package them up and consolidate, in a corridor or a region. So, the strategy has changed. I think the principles are still kind of the same as to what we're looking for. But, it's definitely harder for someone like myself who's a deal junkie and just, wants to buy. You have to have a lot more patience, resilience, diligence, and, think longer term strategy.
Yeah, I think we're always kind of swimming against the grain with the secondary and true tertiary market strategy, and I think, people looked at us like we were crazy in 16, 17, 18, 19, 20 to 22. It's like, oh, brilliant. And then now everybody's looking at us like we're crazy again. And, maybe not.
Maybe we are.
Maybe we're just nuts. But, at the end of the day, it's like, when you're buying in these secondary, tertiary markets, your metrics aren't the same. You're not looking at VPD. You're not looking at population growth. You're not looking at anything else. But you look at the last 30 to 50 years in this population, 15 or 20,000 town with whatever industry is their backbone, it's been the same. It just is what it is, and it's there. And so, I've got a few thoughts, and it's, when you're sitting at the edge of the cliff here, just looking at, who knows, it could get worse, could get better, but, it definitely feels like some of the darker, capital markets times we've been in a long time. And for all we know, it's going to last another 2 years. For all we know, things turn around, or, I'm in studying a lot of like past stuff, whether it's the 80s or .com bubble or 2008 bubble, or at least COVID, or at least the most recent in my lifetime. It seems like, here's all the rules. Like, things go up and then we have to drop, raise rates to fight inflation. But then what always happens is you get a black swan event that nobody predicted, except for maybe a couple people. It hits. And then what happens? The government steps in and bails everybody out, and then you reset and you come back again. And that bailout is kind of what isn't underwritten into these models. And then not that you want to plan on it, but it just seems to kind of be the pattern if things get so bad and there is, call it structural or institutional risk to the, U.S. debt system or financial system, where they do seem to constantly do that. And you see the outbound. So, even through this, just sticking to our strategy, buying these deals when nobody else is buying these ones, even maybe, we think we're paying great prices for them, but probably more than potentially others, because we are one of the larger players taking these kinds of deals on. We're seeing, at least right now, to actually one day consummate an exit here, it's it's probably going to be one of two ways. One, we have to actually really prove it out. Like, we need to show, yeah, we can take this 70% occupied facility, fill it up, get the in-place price rent per month up to 70 or 80 cents from the 40 or 50 cents, per foot a month it is right now. And people will buy yield. They'll always buy yield. They might not give you the benefit of the doubt on a tertiary market and say, yeah, we can get this up. But if you can show a T12 at a solid, cap and price, you'll always be able to do that. And the other is, really understanding that our management company does have some unique principles to it, and this one-to-many strategy that is challenging for other groups to replicate. So that, in general, I think that management approach of these tertiary markets continues to be kind of one of the unique factors.
I agree. And you look at the underlying strategy of the operator. Once again, I did this a billion times. What I wrote my first book on is what the second book's on that's coming out in June, and that's storage as a business. It is not a real estate investment. And so the strategy that you deploy on a facility, right, is very important. And when you look at like our strategy, for an example, our strategy is very much on the financial operations side, revenue management, dynamic pricing, right? The playing of street rates, that economic versus physical occupancy, like it's very dependent on that. And when you look at that, that means we need lots of times a few things. We need people, right? Like it can't be stagnant. The other sides that we have is just traditional. We're getting rid of delinquencies. We're going to try to up occupancy, right? More of that traditional stuff.
Table stakes stuff, yeah.
Yeah. But like for a lot of our stuff, if I don't have a certain population size and a big enough facility, I can't get the yield off of it. It just doesn't work, right? And that's something that the REITs pioneered. Okay, so it was Extra Space that really kind of pioneered this, right? We'd adopted it and it worked very, very well. And the bigger the facility, the more leverage you'd have, right? Now, one of the issues, though, that we talk about and getting back to fundamentals is when you have falling occupancies, right, and street rates dropping, that system shuts down. So when we say we had like a lost year, what we really meant is that value add system, it's not that it shuts down, it still works. In every one of our markets, we had rates that dropped like anywhere from 15 to 20% across the board. Our revenue went up in every single one of them. And the reason being is because we were doing like dynamic pricing rate, even though we were dropping our street rates. But it's not nearly to where, like you're treading water or you're just moving ahead, but it's not nearly as far. And so you need certain set of demands, things like that. The other modes of operations when you're talking about business strategy, though, isn't necessarily dependent on that. And when you get into smaller markets and even smaller deals, your strategy cannot be based upon those types of things alone, because it just won't work because you don't have the volume. Like you said before, mine is contingent. I know when I buy a facility, 60% of my tenants I'm going to kick out. I know I am. If I can't replace 60% of my tenants, my strategy is probably not going to work that well. And so when you have occupancy dropping, right, that stuff slows down. Now, it always comes back, and we were moving forward to do it fine. But the difference in that strategy means in one market, I can be wildly successful. In another one, though, I could literally fail and not know how to get out of it. And one of the things that you guys did was you defined that buy box in line with your strategy, and then you built an entire organization around it, right? That's like I did with ours in like our larger second tier market, same type thing. I know that volume it needs to go, but it was built around the strategy. A lot of people, they buy the asset and try to come up with a strategy after buying it. That doesn't work in this game. And it's going to frustrate you and you're going to probably end up losing or it just not working.
I do believe, any one of these work, and, we were talking a little bit before we started recording, just where the industry sits as far as what share the REITs have, what share the top 100 operators have, what share the true mom and pops have. And, we've seen anywhere from 20% mom and pop to 40%, 50%, back in 16, 17, 18, people said 75%, not top 100 operators. And, I think talking with you, we all agree it's probably under 50% at this point, maybe 30 to 40. Hard to really exactly pinpoint it, but that consolidation's happening. I mean, it's moving the way of mobile home parks, of multifamily, of, commercial, and while those may be a little bit more diverse, than a top 100, when you think about, what constitutes an institutional grade or, even just private equity backed, you really there's not a lot of true mom and pops out there to consolidate or value add. And this industry, it's happening. It's continuing to happen. And I think, we've all seen the supply numbers and the builds, and a lot of developers went in and just built head on into whatever, just assuming demand. And so you are going to see this saturation, and to absorb that in a lot of these bigger markets is going to take time. And I think we're a little bit sheltered from it in the markets that we play in. There are situations where we're on a, exterior MSA and we're drawing from the primary MSA because people drive to save money. And that's where we are a little bit impacted, because you're not going to save money by driving out when you got 200,000 square feet leasing up. But when we talk about our price per foot, I mean, a lot of our deals work if we don't get over 50 cents, 60 cents a foot a month. Like, we want to get up to 70, 80, $1, et cetera. But when they work there, I don't see a lot of scenarios where it goes down. And if you can't fill the occupancy, there's different things that will impact that, but it's not like inflation is going the other direction. And when you're talking about paying $50 a month or $60 a month for a 10 by 10, like, it doesn't matter what city someone's in, they can sustain that, and you can continue to kind of drive that with occupancy, whether it's 10%, 20%, without these massive dollar values. When you've got someone in a downtown Class A metropolitan area paying $400 a month for a 10 by 10, and you're going to bump them to $550, that's when they might start second guessing their decision to keep that storage facility. So
if you're at $2 a square foot plus, those prices can and do come down. And we see them volatile. We saw that in some markets where Public Storage comes in, they open up, and they've been notorious about this, but they've taken a $200 rate to $50 on a street rate. And the reason why is because they'll go to $50 and then they'll bump them up to $150 3 months later, right? But the point being is they have the buffer to do that. If you're starting at an $80 rate, you don't have the buffer to go to $20, right? So when you have that $2, $3 rate, we see much larger fluctuations in street rates. When you're in small cities where you're at not $2, $3 a month a square foot, instead you're at 50 to 60 cents, you don't see it go in half. That doesn't happen, right? There isn't enough. People are like, I couldn't even do it. I couldn't pay my bills, so it doesn't work. So they are more stable in that way, which is really funny, because that is contrary to what is the belief. It should be, no, a $3 market is more stable, right? So when we look at things, we're obsessed with the overall durability and the percentage of income and how much people, because you can see some of those markets where I'm like, people can't pay anymore. They just can't. And you have a bump in the road and you have to compete. Everybody can get really competitive, and new storage facilities can open because the development numbers make sense at $2 a square foot. When you're at 60 cents, they don't. You literally can't build the thing and make money at today's cost. So all of a sudden you have mass demand because nobody can put in new supply. So all of a sudden you have what I call a rate runway, and the rate runway is a lot better. That is totally opposite of what people think. $3 is more stable, less supply can enter the market because it's harder to do, but that's actually not true a lot of the times. And we're seeing this now in big markets. Like, you go to big growth markets where it's Phoenix, where it's, Phoenix is 7 million people, right? They were one of the largest rate drops that we even saw. And, a first tier market dominated by REITs. You go into these other markets, these third, fourth tier markets, and they didn't have a drop at all. Rates didn't move. And that is contrary, I think, to what was prior belief that most people had.
You see that in housing too. I mean, everything, they had these big influx to these massive cities in southern, Florida, whatever. And I mean, you see these massive lifts, and then you see big corrections, and it's the overhype and the run. And then, and people aren't sprinting to these smaller tier MSAs. So I don't know, I mean, again, I think for us, selling these things down the road once we've added value is always the end goal, but we're operators first. And so if you're buying stuff that you can operate indefinitely, not that that's the end goal, you do want to get the yield and return capital, but structuring it so that you can really gives you that autonomy to wait and see and just keep kind of trekking up. I mean, like you said, you almost lost a year. I mean, same for us. I mean, our facilities globally, I think, are 74-75% occupied today, a lot of which is driven by the fact that we built over 1 million square feet in the last year. So we've just got a lot of additions and expansions to lease up. Like winter, like in January, we were like 70, 71. So we're already seeing pretty good trajectory this lease up season. And for where we're at, we can get that up to 85, 90 within the next 12 months. That's it's a really beautiful place to be with where we started on a lot of these in these secondary markets. So.
Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. We were talking about this earlier, and you've touched on it. I really want to hit on it because I think this is a really important thing coming from where you guys stand. And this is this idea of acquisition runway. So Andrew and John, we were talking about this before, and I know John touched on it, Andrew touched on it a little, but I want to really get this and talk about this because I think it's an important thing and it's very key to you guys. And that's that the overall numbers of mom and pops in the industry, how those numbers are broken up, I think they're wildly misleading. So first of all, a lot of people report a number that it's like 75, 80% of the entire industry is mom and pops. What they're doing actually is all they're doing is taking publicly traded companies out of the equation. But that's not where the vast majority of facilities are owned, and they're not mom and pops. These are large, regional, private equity, and these are billion-dollar companies in a lot of cases. These are not mom and pops. And they make up a bigger percentage of the pot now than the REITs do. And in fact, they make up such a big percentage of the pot that if you look at including those, and a lot of people say, well, if you take out the top 100, which is interesting because just go back 6 years ago, the top 100 included people that didn't even have 1 million square feet. They had 300,000 square feet, right? The top 100 now, in order to get to the same level of operators, we would need to do a top 2 or 300 than how the top 100 was literally just 5-6 years ago. So that expanded. The top 100 owns so much more. The top 200-300 owns so much more. And that puts actual mom and pops probably down to 50% or less. Now, if you look at the mom and pops that are institutional grade, that's probably less than 10% at this point. And institutional grade meaning first tier markets and size big enough to where they would build them in population. If you even go to second tier markets at this point, it's definitely under 50%. And so that 50% mark is including third tier, fourth tier, and fifth tier markets. And that's where 80% of all mom and pops today are owned. You go into major cities, everything else, it is going to be hard for you to even find a mom and pop person at all, which is wildly different. So this runway of acquisitions that you're looking to, a lot of private equity guys come in and they think, I'm just going to go into Southern California, Austin, Florida, wherever that may be, and I'm going to buy 120,000 square foot mom and pop facilities and turn them around. And then all of a sudden they're like, these things don't exist. And if they do, they're selling at 4 caps to a REIT. So, that play in that runway, which was very lucrative for me, right? Coming out of 2009, all we did was that. 130,000 mom and pop, right? So that's gone. But where the runway and opportunity now is in the industry is where you guys were playing in. And I think that's what it has to do with your growth because you have this long runway, right? These third, fourth, fifth tier markets, they dominate all the mom and pops at this point. And that consolidation is happening from people like you, from us, and other people that can play and they can move. REITs can't. It never makes financial sense for a REIT to go buy a $2-3 million facility when you're a $50 billion one. They're not set up for it. They're not. Instead, what they want to do, they want to go to guys like you, and then they want to say, hey, we're not going to buy it one off. Instead, here's a check for $1 billion. I'm going to buy your 200 facilities, right? And you're like, great, we bought them for $300 million, so we appreciate it. But that's where really the next kind of frontier and everything.
I think studying other industries, it doesn't seem.
I hope you're right, by the way.
Yeah. Me too.
I would argue that, but Extra Space just a couple years ago showed us that.
Yeah, I was dipping their toe in the water too, So, no, I mean, I think you're right, and I think if you look at other industries, whether it's gas stations or dollar stores or franchises, I mean, these secondary and tertiary markets oftentimes get overlooked. And I think in this industry, you're in one of those spaces where it is just it's one of those basic industries that work in every market, just work differently. And you do see that consolidation with other assets. It just hasn't happened here yet because it is messy. I mean, most real estate assets, you're not dealing with 500 tenants who are writing you checks, half of whom are dropping off cash. And, we're doing the dirty work, the cleanup, I think
there's a lot of importance and emphasis put on the backbone, the management, as you kind of maybe saw with like Extra Space. They didn't necessarily know how to run those assets. So how much was put on the tech or the management of that?
When I started out, guys, there was not the ability for me to do a portfolio management in an efficient way with assets spread across different MSAs, different cities, states that were that small without people on the ground. The property management systems, we literally didn't even have the ability to say, what are all my facilities doing today? How are things going, right? There wasn't technology that allowed us to do portfolio management in that size. That's why we had to leave it, because we were big enough to do portfolio. And we had, I think, in 3-4 different states, 8-9 small facilities. And it literally was like, this doesn't make sense because the management part was so expensive, where technology and what it's done today and what you guys can do is now you can operate those in a way that it was really hard for us to do. And you guys have all the information. I can ask you guys a question about your facilities, and you could literally just say, hold on. And you could tell me from this hour, this is what happened this morning.
I got my movement summary today open right now. I'm seeing all the move outs today.
But again, it's like we said, we've got that fluidity, that nimbleness of this small, true mom and pop organization, but we've got the backbone, the economics, the debt, the equity behind us of probably on par with some of the largest players. And, I think the other thing that I'm always a believer in, to my knowledge, Public Storage does storage. Storage. So I don't see the day where they're just like, hey, there's nothing more for us to do in this space. And to all of our investors, our shareholders, et cetera, we're just done. We can't build anymore in Austin. We can't build anymore in Tampa. We can't buy anymore in St. Louis. So eventually they are going to have to go to these second, third ring markets if they want to continue to show growth to their shareholders. I don't see a day where they just say, hey, we're Public Storage, we're going to start buying gas stations.
Management will be kicked out. That's the day that when they say we're done buying something, they say we'll find a new CEO and we'll find a new everybody to find more to buy.
So time is a great equalizer. Don't know when they start going to those markets. We saw it a few years ago. I mean, I remember, you'll probably appreciate this too with some of your markets. I was talking to a C-level executive at one of the big companies, and he's like, look outside your window. How many people do you have in a 10-mile radius? I'm like, I don't know, 600,000 or whatever it is. He goes, you have more people in a 10-mile radius than the entire state of Idaho or Montana or such and such. We will never go to that state. COVID happens. You see a mass exodus out of a lot of, the Texas, the California. Where are they going? They're going to Billings. They're going to Bozeman. They're going to Coeur d'Alene. They're going to Boise. Who follows that? All of these large companies, and next thing you know, they're just chasing down these deals until it gets overpopulated, saturated. So again,
4 years ago, 0 REITs in Boise.
Yeah. Oh yeah.
4 years ago. And they literally said that. They're like, there's not the population to sustain it, the management, the operations. Right now, all of them are here.
And we've seen that time and time again. I mean, we saw that, in the markets we play in. We grew up here in the Midwest, and it wasn't because we had a crystal ball. It was just serendipitous. Hey, we want to buy facilities 3 hours from home base, which was Minneapolis. At the time, you didn't really have anyone trying to consolidate and chase Minnesota, Wisconsin. So that's what we did. And now they're, coming in slowly in large numbers.
I think it takes a fundamental shift in just what it takes to operate these things. It is a different game. It's a different business than Class A, even Class B stuff. And it has to be managed differently. And it's not, there isn't some silver bullet technology out there. I mean, we see it all. So I think some people go a little too far, like AI is going to solve all my problems, whatever. Like there's cute little things you can do, but I think you can get lost in it. I mean, the reality is we use 95% out of the box software. We configure it, we integrate it. We have our own data warehouse that we build Power BI reporting tools on. We have an incredible team of data scientists doing that stuff, but we're not trying to reinvent or use technology just to make it look sexy. It's all in our team's ability to operate efficiently with the tools that we have. And that's, I think, the key differentiator. Like, we've had 5-10 groups come through and just tour our, headquarters here. And what we'll do is we'll set up an hour with each of our departments and just kind of let them just walk them through it. There's no rocket science to any of it. It's really just doing those 30 basic things right and using the tools when they actually are capable of working and being reliable to do them effectively.
Well, and that's the thing that is the biggest difference that everybody needs to realize, what you just said, because when prior to 2000, really probably 18, the tools of the REITs, we did not have access to. We did not have access to the third-party tools out of the box like you're seeing that these REITs had, that Extra Space had, everything. They were operating on a level that even the largest regional players couldn't imagine, and they had no access to it. That is totally different today. All of the tools fundamentally that they're utilizing, right, we have access to. Now, they may have them way better because they have centralized data. The point being is, though, we have access to them. And that is an incredible difference in the last 5 years. This has been a rough, let's say, 22, 23, right? You mentioned the turn, and I can speak on this and why it makes me think of it is the end of 23, I came in and said, okay, we're going back into our heavy revenue management, everything, and going, because it was like it's time where we really held off before obviously drops, and so we're sitting between 70 and 75% occupancy. We're filling up. We're doing, we did so far this month. It was like, or in April, it was like 500,000+ rentals. So it's all of a sudden we're seeing upticks. We're filling up. It's not nearly as strong as it was ever, in the last 5 years, but it is definitely not 22 and 23. What are you guys seeing? You guys have access to lots of markets, lots of states. What are you seeing today, and how has it changed in the last year?
We're benchmarking against ourselves, and with the growth we've had, our team has grown. Last year was really the first full year we had a team of, called 6 revenue management data analysts that were eat, sleeping, drinking, all of this. So I don't want to discount that some of our performance may have been just a result of doing it better because we had the right people in the right place to do it versus prior years. So, there's no doubt 21, 22, you could trip over yourself and have great lease up. It just happened. And if anything, kicking ourselves for not keeping rates high enough because you were getting the move-ins either way. 23, we stayed, I think our same store occupancy when I looked in December was up like 4.9% from a year earlier, which is certainly a lot lower than we would have hoped for growth. And in prior years we were seeing 15% plus type moves. We were up about 10% on same store revenue. So, kind of like you saw, you were able to push rates a little bit alongside the lease up, but we had to spend a lot. We spent a lot on Google ads, Sparefoot, pulling from surrounding markets, et cetera. If you think there's, 100 units in a pie this year and we captured 30 of them, next year it might only be 50, and to capture that same 30, you got to rank, you got to drop your pricing, you got to have that visibility digitally, especially when you're more tertiary. This year, Jan, Feb, pretty abysmal. We also pulled back on our ad spend a lot just because those are generally really slow times and we didn't really want to piss in the wind on the marketing dollars. April, we are seeing is tracking on pace, if not a little bit better, pro rata to how many square feet and how many stores we have. So like we had, I want to say about 5.5, 6 million square feet this time last year. We're at about 8 million now, and we're up on move-ins about the same, and move-outs are slightly down. Now, we also aren't as aggressive on the rent rate increases yet because we really are focusing on unit occupancy, just seeing all that, square footage out there to lease up. We're really driving on that. So, knock on wood, I try to not to get too deep into like, well, if the housing market turns around, then we're going to see, because reading anybody's posting on, rentals, people renting properties drives just as much or more than people buying and selling their homes as far as storage tenants. But then there's 50 other reasons in any given market that somebody could need storage. So rather than really just trying to pinpoint like, hey, these 5 things, or, if it goes our way, it's going to be great. It's really just looking at what's happening. And I think generally, even despite all these headwinds, we're seeing a positive trend already this lease up season. And then really optimistic and hopeful, May, June, July, maybe even into August continue. I do think, historically, people will, the principles that drive storage of just hoarders and, Americans in the baby boomer transition. And, I look at some trends. Again, I take all this data with a grain of salt because it's garbage in, garbage out. Who knows whether they're really sourcing it? Was it a 100% survey or what? But you're seeing, Gen Z and, millennials, and they're pacing at the same rate as prior generations, for their age group, where they're at, from what I can tell anyway. I don't know if you have different data, but
well, yeah, they are, because it's a percentage or even higher. Millennials are the largest utilizers of storage in the world right now. So they've already, in numbers, they've already surpassed baby.
And people are living longer. Life expectancy is going longer. So your population is just perpetually going to grow. You're going to accumulate more stuff. Not that any of these are one big thing, but when you just think about the strength and durability of the industry, all those factors, whether they're today, tomorrow, next year, are going to lead to pent-up demand. If people aren't moving as much, I saw 2023 was the lowest home sales, existing home sales in 20 years or whatever. Again, don't quote me on this stuff, but it's ballpark data. Well, eventually they're going to move. Not everybody's just rate driven on that, and so when that does happen, I think you will have a little bit of a rebound, similar to, what you saw in the COVID years for other reasons.
You'll have pent-up demand.
It's just the same things will drive the demand over time. So it's really just preparing yourself for these windows where, like you said, it's like a lost year or whatever, but doing what you can when you're in it. So I'm optimistic. It's
the sellers that are sellers today, we're getting deals that we haven't seen in years. Seller financing, we're getting off-market deals. We're buying them at 200-300 basis point higher than they would have sold for 3 years ago. The problem is there's just not a lot. So when we get a deal, it's good.
Yeah, I think that's the silver lining. We're finding a lot of deals too that we're like, we can't even build this for that cost. And they're stabilized-ish. So John and I are looking at each other. It's like, well, maybe we don't love the cap rate, the inbound, but if we're confident in our abilities as storage operators, we know time is the great equalizer. We can go as deep as we want and get nitty gritty, but the highest level, it's like, okay, we have an opportunity to buy a $40 per foot facility in what we believe to be a great market. If we can't make this work, maybe we shouldn't be storage operators.
You think about inflation and the cost to build. Again, whether it's 3%, 9%, I don't know what you're building for now, but on our low end for the no frills basic, we're maybe 50 to 60 foot drive up, and that's like a really, really good price, I think, industry wide for what you can do to build. And climate could be anywhere from 60 to 120 depending on how many bells you want to put on it. But those numbers aren't going to go down in the next 5 years. Like, the benchmark is only going to go higher. And so that's really kind of where we're like, yeah, if it's a 15-year-old facility, but they've kept it up, the infrastructure is good, maybe it needs some Everbright or new paint or whatever, but like generally it's a good facility. That's where a lot of our focus is right now. Just kind of on that longer term vision.
Couldn't agree more. It's, these spots that I'm going to say air quotations, challenging, things like that, which is really only challenging in the perspective of how obnoxious the previous 4 years were. And that has to be taken. Everybody's got to be, well, I heard that, it's suffering or it's already, I'm like, well, hold on here. Like, do you mean that our occupancies is back to a historical normal high? Okay, yeah, that's true. Like, it's so struggling is, the market of buying and selling the asset has gotten screwed up. Not necessarily nearly as much as the asset and price. It's just that interest rates have screwed up valuations, what people can pay, and that's made it hard for sellers to come up. But that's actually the best thing for us. For a normal market to have normal opportunities that takes value into consideration is a good thing, not a bad thing. And we improve value. So we actually want to buy something, not at the value that it's going to be after I improve it, which is, how it's built in. So although it's like I don't see as many transactions, the deals that we're getting are better. And they're better long-term deals, right? But I think it's also going to increase because interest rates aren't dropping. They're not going down. And so it would take a black swan event to have that cause anything else. So you have a lot of sellers that finally go, a year and a half, I got to sell.
Eventually they hit the fatigue. And it's interesting. I mean, this, I've gotten more and more curious about broader capital markets when you think about this stuff. Because if you really follow the flow of money into the different asset classes, and I'm not talking like our level, I'm talking like billions, tens of billions of dollars.
Things that actually move the needle.
Where are they allocating it? It goes from equity when money's really cheap. Now everybody's, doing it. They position themselves or had to position themselves for private debt. And then you think about the asset classes they're funneling that money into, and where, 10 years ago, office was the best. Now, I mean, not the most obvious, elephant in the room, but I mean, this secondary and tertiary office space is just not, there's nothing anybody can do with it. But how much capital was allocated to that prior that's still out there that needs to be allocated somewhere is my question, And so regardless of rates not going down, other things, this money has to flow somewhere. Some can sit in treasuries, some can sit wherever, but like eventually people want yield for their cash. And I think, what industry are they going to float it to? And I firmly believe this continues to show those resilient aspects. And it's why you don't see as much distress. I mean, short of what I've seen, handful of developers that aren't operators that, had to sell upon completion and they built for $140 a foot. Like we're not seeing $2 million sellers say, "Oh, my bank's calling the note." Like they haven't played the capital markets aggressive enough for that. And the bigger operators that have a lot that maybe got a little too aggressive. I mean, you've seen, I can say anything, but there's a couple large transactions that have taken place that, maybe got a little too feisty on floating rate debt and whatnot, but other than that, you're not seeing a lot of this, like, call it $2 to $30 million price point range where things are trading hands because they're truly distressed. The group either has enough cash to hang on through the cycle or they position themselves well, but it's more so, people that got a little feisty with rates and, floating and that. But you saw a lot more of that in like multifamily and triple net lease type commercial type stuff.
As far as commercial real estate goes, we're the lowest defaulting, and our problems aren't even remotely. It's not even like talking about office and storage and the same thing is you might as well be talking about totally different. They're not even, it's like, and I hear this a lot, and I'm like, okay, first of all, like our default rate in storage is below 2%. I mean, it's wildly, shockingly low when you compare that to anything else, especially in commercial real estate. And so you're right. When you start to look at the industry overall, where's money going to go? It's also risk adjusted. So if you have something that gives just the same yield, or in storage, a higher yield, and you have a default rate that is multiples, we're talking 5, 6, 10 times less. And so when people say, oh, commercial real estate's distressed, everything happening, but that's not happening in storage. We're not seeing it yet. Moving forward here, what is your guys' plans? I mean, you're already crazy big. What are you guys doing? What's this year look like for you? And then what's the next 3 years look like for you?
Right now, compared to a year ago, we're probably acquiring at about 40 to 50% dollar for dollar, over the same time frame that we were, just given the criteria and what we need to make deals work. Our construction arm, KO Construction, is really a huge focus for us in growth area. We've got probably 4 to 5 parcels of land we're looking at, potentially acquiring and developing with our own sources of debt and equity that will be the developer, the builder, and the operator on. But they've really built, similar to our management company, a pretty amazing system for development. I know there's a lot of softwares out there that serve construction industries and whatnot, many of which are really probably too robust for what we need, but we've really built a tailored, specific solution using something called Smartsheets. It's just kind of a fancy Excel with dashboards basically, but configured to meet our needs to be able to develop in 50 plus different MSAs, dealing with small municipalities, being able to take on a 10 or 20 or 30,000 square foot expansion in a small town with very hyper localized contractors, all the way up to a 3-story, 90,000 square foot climate controlled facility in a Class A, Class B market, and everything in between. And so, not just focusing on our own internal stuff, but really where we can service others in the industry, whether they're a mom and pop or a larger operator that maybe is a great management company, but they outsource their construction and they still need somebody on their staff who's overseeing it, basically GCing it like some GCing it almost. And I think, as we've started to talk to the market, there's a lot of need for that right now. You've got a lot of developers that do a beautiful, great job, but they really focus on kind of the larger scale stuff, and rightfully so. And I think, our position is both an operator, an investor, a developer, and a builder. We also give a unique eye. We're not going to sit here and just not tell somebody their rates are crazy, or help them value engineer a unit mix that they may not have insight into and whatnot. So there is some unique advantages to that too. So we're focusing on that a lot, talking to a lot of groups, focusing internally. Again, whether or not we can keep buying mom and pop facilities at the clip we're buying them at, I do think you're always going to be able to, if you have the right team, find markets that are underserved that can be developed. And it's challenging today because when you've got 12 to 18, maybe even 24 months of just getting the entitlements and getting it built. It's a long time to float equity out there and still be able to get a really good IRR on an exit. And if you're underwriting at today's street rates, which kind of got to do to be conservative, or even better, even lower, for lease up, you're looking at a 3 to 5 year runway to stabilization on these things, and people aren't paying what they were paying at CO anymore. So it is, you got to look. I mean, we're looking at dozens of deals to maybe find one that we pull out of it, but when we do find them, they definitely are pretty ripe for opportunity.
And I think operationally, the biggest thing that has kind of just been our 2024, line is control our controllables. I think it's something we stole from you that we use quite often, margin of stupidity. We're not the best, we're not the brightest. We know a good deal of storage. We've got a lot of smart individuals. We always bake in a good amount of margin of stupidity, but your guess, John's guess, my guess is to when we'll see the next, call it elevator, uptick in demand, we don't know. But what we can control is our expenses and really focus on our controllables. So, I think that's one of my biggest, emphasis right now, as well as, continuing to build relationships with off-market sellers, brokers, going to shows, you name it, and just kind of making sure we're continuously well positioned to be there.
And something you said earlier, I think, we're measured on how we do over time, and that's the nature of this kind of syndicated real estate, or even our own deals. It takes resilience in these types of environments to not panic, stay the course, make sure you're positioned for this, because it always comes. You never know when. But if you don't hit a pref payment this quarter, but you're managing your balance sheet, but you're still able to deliver a 30% IRR in 2 years, that will always be rewarded and recognized over time. And I think that's really kind of what we're focusing on, is just making sure every single entity we have, whether it's ones we own or ones that have investors or a broader, fund entity, is properly equipped with its debt, its balance sheet, its cash on hand to, hey, if this lease-up season just completely shits the bed, are we going to be okay in November when we're entering the cold winter season again? And conserving cash and operating and making sure that if we have any debt renewals, getting ahead of it, working with the lenders to prepare for that. That's really what you got to do.
Well, and since day one, we all probably saw it. We probably saw in 2022, 23, people who saw this as now the sexy asset class, saw what you were doing, saw what we were doing, and they were title, they were, debt brokers. Hey, the opportunity that you passed on to AJ and that we passed on, why don't we pick it up? We see something they don't see. They're underwriting historic highs, continuously pushing rates 20% year over year, and they're going to go develop another 50,000 square feet. And they're also on floating debt. Those are the ones who are hurt. So, we've said it time and time again, we are operators first. And we always will be. And I think that will be what helps us continue to grow and perform positively through these times, because sure, who wouldn't love to buy an asset and sell it in 24 to 36 months and get all of our investors a phenomenal IRR, but we can't always have that favorable of an outcome. So if we have to hold this asset for 5 years, 7 years, 10 or 15 years, are we positioned, well enough to hold that asset?
I call those value traps, where you're trapped because of a value that doesn't have anything to do with you. And they suck. And I see it all the time, where somebody's like, it's worth more. Well, it doesn't matter if you have to sell it, because it's worth whatever somebody will pay. And so don't get into that trap.
It's like buying a stock on margin and getting stopped out, even if it's a great company. You know, you got to be able to, if you're confident in the company and you're holding that equity and you know long-term they've got the vision, you got to be able to weather the quarter-to-quarter fluctuations that really don't impact anything. That one share is still one share. Like your asset is still your asset. Our revenue isn't going down. Today it's worth less than it was a year ago because of the capital markets and cost of capital, but that asset is really what it is.
And then too, in real estate, it's shocking to me how many people think real estate's a short-term game. And they're like, no, I know it's a long-term game. Like, we're talking like a couple years, right? And I'm like, no. That is not what long-term means. In a world of social media and TikTok where we can't hold our attention for 9 seconds, 6 months may be a long time, a year may be a long time. In real estate, that's not a long time. And it's, I think people forget how the game even works. And it's important that as you're buying not thinking in a year or 2 year increments, because you can't control those outside things. And that's where a lot of people got in trouble. They thought this is a quick hit, a quick win. I'll get floating rate. I'll do all these things. The short term is where I'm going to be out of this thing.
I call it the hot potato game.
Guys, I could obviously keep you here all day. We're already gone well over an hour. I really appreciate you guys coming on. Love what, obviously discussing, love what you guys are doing. Where can people go to find out, man? Where can people reach out to you?
We keep it pretty simple. It's just Andrew at KO Storage or John at KO Storage. We're on LinkedIn. You can shoot us an email, find us on LinkedIn. Pretty accessible. We love talking with other operators. So either one works.
Trade more notes. You want to sell your facility, you want to develop, just want to pick our brains, whatever. It's, it's a small industry, and just love building relationships with everybody that's a part of it. So.
Well, guys, thanks. Great seeing you as always, and we'll talk soon.